Welcome to CLiK Weekly Markets. This is our market summary for the week ending the 16th of January 2026. As always, this is educational commentary only, not financial advice and not trade signals. Let's walk through what actually moved markets last week, what that tells us about positioning and what traders should be watching next. If we had to sum the week up in one line, it would be this: softish inflation, resilient demand, and a Fed that's comfortable pausing kept overall risk steady. But leadership rotated hard into small caps, while precious metals and crypto caught a proper bid. That theme of rotation rather than panic runs through everything we saw last week. Looking at the scoreboard, headline indices were mixed. The S&P and Nasdaq drifted slightly lower, while the Russell 2000 stood out with solid gains. Precious metals and digital assets delivered the strongest returns on the board, particularly silver and crypto, while mega cap tech names came under pressure. The key point here isn't whether markets were up or down, it's who was leading and who wasn't. Six main forces shaped price action last week, and together they created a textbook example of rotation rather than a single clean directional move. Understanding these drivers helps explain why small caps rallied, mega cap tech cooled off, and alternative assets attracted fresh capital. US macro data delivered almost exactly what markets wanted to see. December CPI came in broadly in line on the headline, with core inflation running slightly softer. That reinforced the idea that the Fed can afford to pause without risking inflation reaccelerating. On top of that, retail sales beat expectations, showing that consumer demand remains resilient. This combination, inflation not getting worse while demand holds up, usually leads to rotation, not an everything rally. It supports cyclical and domestic exposure, but gives less support to long duration, highly valued growth stocks. Fed Vice Chair Jefferson described policy as well positioned, signalling comfort with holding rates at the upcoming meeting. That tone matters. It removed urgency around near-term rate cuts, which helped cap enthusiasm for rate-sensitive growth stocks while keeping the dollar supported. In short, the Fed didn't turn dovish, but it didn't need to. This week was all about rotation rather than direction. While broad US indices slipped slightly, participation underneath the surface improved significantly. The Russell 2000's strength is a classic signal of investors rotating toward size exposure, something we typically see when growth looks durable and financial conditions remain stable. At the same time, capital flowed into real and alternative assets, suggesting investors are hedging multiple scenarios rather than betting on a single macro outcome. Precious metals delivered standout performances. Gold rose steadily, doing what it tends to do during periods of policy uncertainty, acting as a hedge rather than a pure risk-off asset. Silver, however, was explosive. Its sharp rally reflected a high beta version of the metals trade, driven by a mix of industrial demand expectations and leverage to the broader metals complex. Academic research consistently supports gold's role as a safe haven asset during regime uncertainty, and last week's price action fit that pattern well. Digital assets also caught a strong bid. Bitcoin, Ethereum, and Solana all posted solid gains as risk appetite returned, and reported ETF inflows supported prices. Bloomberg highlighted large option market positioning being run over as prices pushed through technical resistance levels, adding momentum to the move. What's important here is context. Crypto is increasingly acting as a portfolio alternative, not just a pure risk asset. With Bitcoin approaching the psychologically significant 100,000 level, volatility behavior around that area will be critical to watch. Three simple takeaways frame the current market environment. First, US indices are rotating, not panicking. The key signal was small caps leading, not headline index weakness. Second, the Fed pause narrative continues to support the US dollar, particularly against currencies where rate cuts are still being debated. And third, metals and crypto are both behaving like alternative allocations, reflecting investors hedging uncertainty rather than chasing pure risk. Looking ahead, several catalysts could quickly shift the narrative. Earnings season ramps up with major names reporting, and guidance will matter more than headline beats. Markets will remain sensitive to any data that changes expectations around the timing of the next Fed move. In the UK, follow-through data after the GDP beat could reprice sterling and UK rates. Oil remains vulnerable to geopolitical headlines, particularly around Iran, Venezuela, and the Black Sea. And in crypto, flows and positioning will be key as Bitcoin tests major psychological levels. The big message from last week is simple. Markets aren't confused, they're adjusting. Rotation, alternative assets, and selective risk-taking are all consistent with an environment pricing decent growth without perfect policy clarity. Stay focused on what's actually moving prices, not what should be moving them. That's it for this week's CLiK Weekly Markets. If you found this breakdown useful, give the video a like. It helps more traders see it. Subscribe to the channel for weekly market commentary focused on structure, rotation, and what's actually driving price, not hype or signals. And if you know someone who'd benefit from a clearer, calmer view of the markets, feel free to share it with them. Thanks for watching, and we'll see you next week.